to be presented. I think in due course the full papers will be uploaded, so the participants and all others who may be watching this program through the webcast can go through the papers. Now this is, this will cover diverse topics, and it will really be of great relevance to the regulated entities, the banks, the non-banking financial lenders, the other financial institutions, as well as to the supervisors in not only in Reserve Bank of India, but also in other central banks. It will also be of extreme use to the senior management of banks and the NBFCs. And I am very happy in this context to note that some of the CEOs of our banks are also present here. The CEO of IBA is also present here. Now, the theme of the conference, Keeping the Financial System Resilient, Future Ready and Crisis Immune, is one which will never lose relevance, no matter which side of the economic cycle we are in. In fact, the ethos of being future ready and resilient against crisis needs to be built into every financial institution. It has to become a key element of their organizational culture and ethos. It has to be developed proactively when the system is healthy, rather than reactively when there may not be enough headroom to strategize and implement. Now, there has been talk of late about whether supervisors world over have fallen behind the cycle. And the talk has started, the discussions have started in various fora, in various international fora in which I get opportunities to participate, including the International Monetary Fund, the BIS and other institutions. With the failure of, a few banks in the United States, with the failure of the giant Credit Suisse, which has been there. I mean, it was one of the leading institutions in the world, in not only in Europe but in the world. Now, supervisors all over the world have suddenly, there is a sudden sort of renewed interest, and questions are being asked whether the supervisors acted in time or whether they fell behind the curve. The US Fed has done an analysis with regard to the failure of the banks, the 3 or 4 banks which happened in the United States. And they provided an excellent analysis of what exactly happened and why it built up. One gets a sense, I'm not specifically saying with regard to the United States, because I don't have all the internal details which the regulators and supervisors should be having there. So I'm not saying in the context of what happened in the US or in Switzerland. But generally I am speaking, one aspect is that the supervisor should be absolutely in sync with or ahead in judging a build-up of a crisis, build-up of a stress. The supervisor should have that capacity. The other element which is equally or perhaps more important is timely intervention. It's not enough that we know that there is a problem building up. It is absolutely necessary that we act in time. There could be a problem where there could be a problem in countries where the supervisors are a different entity, but the institutions which will enforce and take the proactive measures or the regulatory powers are vested in another organization, in another institution. So there is need for close coordination between the two. That is also very important. Fortunately, in India, given that Reserve Bank is a full-service central bank, both regulation and supervision and several other aspects of the financial sector and the financial markets, the money markets, they're vested with the Reserve Bank. So as a result, the Reserve Bank has the unique advantage, and it is uniquely placed to use the various arms of the central bank, that is Reserve Bank, and to deal with a crisis. Examples of fixing the problems in, let us say, the Yes Bank, which happened in 2020, right through end of second half of 2018 and 2019, we saw that there was a problem building up. We tried our best through various other methods to act. The supervisors, the Department of Supervision, Department of Regulation, all other departments were very active and closely coordinating and trying to deal with the crisis, the build-up of the crisis. And when it became necessary, naturally both supervision wing of Reserve Bank and the regulatory wing of Reserve Bank, that is the Department of Regulation and the Department of Supervision, and of course the legal department, because they had an important role to see that what we are doing is legally right. So therefore, I think there are advantages in having all these functions in one organization. There are counter arguments to it also. I am not going into the details of the counter arguments. Maybe, a different matrix in another country can work better. I mean, it is for them to take a call on their their country situations, because circumstances, the overall environment and so many other factors vary from country to country. Each country has to choose its own method. But in our experience, I think having all this vested in the Indian Central Bank, that is the Reserve Bank of India, has been of immense use. So that is one point which I would like to highlight. And I mentioned that there has been debate that has supervision fallen behind the crisis. So, but again, as Dr. Ravi Mishra pointed out, and as you would be discussing perhaps in one or two of the subsequent sessions, we started this entire exercise of trying to be as proactive as possible. I cannot afford to say that we are smelling a crisis on every occasion, but it is our endeavor to smell a crisis, because we can make best effort. On best effort basis, it is our endeavor, and it is at the forefront, it's at the, forefront of our agenda, it's at the back of our mind all the time to see if something is building up either at the systemic level or in an individual institution, in an individual organization. And today, in today's world, given the complexities that we have, a stress can originate from multiple sources. It can originate from certain factors within an organization, within a bank, or within a financial entity, or within a NBFC, that is a non-banking financial company, that's a non-banking lender. It can originate because of certain deficiencies within the organization. It can originate from a very small problem in some corner of the balance sheet of a financial institution, which the management may think it's something, doesn't merit great attention, but it can suddenly build up. Or it can take place due to external factors. It can take place because of climate issues. It can take place because of business cycle change. It can take place at times, if there is even monetary policy also, if it's not keeping in sync with how the economy is moving, it can potentially create a crisis. It can also come because of some technology outages, and technology outages can be due to your own internal problems. Your IT system has failed, or in the larger scheme of things, if there is a failure at the other end, then it hits you also. A crisis can also come from a fraud if it remains undetected, and if it is allowed to remain and persist far too long. So therefore, I think supervision has become a very complex task. Among the younger lot who are present here, I am not scaring you. It's not that difficult, but it is complex, and we need to realize that it is a complex world, and our supervisory methods should be our best endeavor to remain in sync with times, not only in sync with times, but also to see the stress before it builds up, and to take proactive measures. Last year on November 16th, we imposed certain regulatory macroprudential restrictions on unsecured retail lending, on bank lending to NBFCs, and on a few other aspects. Because we saw that in the credit market, some potential problem would have built up. There was the headline numbers were looking good, the parameters were looking good. Even now they are all right, there is no problem. But we thought, please mark my words, we thought if left unattended, these aspects, these vulnerabilities can become a bigger problem. So we thought it is better to act in advance and slow down the credit growth which was happening in these segments, because we could clearly see some evidence of, dilution of underwriting standards, some evidence of proper appraisal not being done, but the mentality to join the bandwagon and just go for unsecured credit. I'm happy to report that our timely action, there was no problem at that time, there is no problem even now. But our timely action has resulted in a situation where the growth of unsecured credit, that is the lending unsecured loans, it was in the order of about 30% year-on-year growth. That has now moderated to about, unsecured credit has moderated to about, within that, some segments, if I remember correctly, I think credit card was, outstandings were growing at 30%, now they are about 23%. Similarly, the bank lending to NBFCs which were also about 29-30% have come down to about 18%. So therefore, this is how one has to really, this has to be our endeavor, and supervisors have a very important role to play here. Fortunately, in India, all stakeholders, namely the Reserve Bank, the various banks, the non-banking financial companies, that is the NBFCs, and the government have made tangible efforts in this direction. India's domestic financial system is now in a much stronger position, characterized by stronger position than it was before we entered the COVID peak, the period of the COVID crisis. So Indian financial system is now in a much stronger position, characterized by robust capital adequacy, low levels of non-performing assets, and healthy profitability of banks and non-banking lenders, that is NBFCs. I would like to compliment the banks and other financial sector entities for such a stellar performance in the year which has just ended on 31st March this year. There is, however, absolutely no room for complacency, because the world is changing, challenges are coming, growing complexities are happening, and as I said, problems can originate from any corner of the financial system within the country or from any corner of the world because of something which may be completely unrelated to you and me. So there is therefore no room for complacency. We must keep constant vigil and continue to take proactive measures to sustain this progress and this performance of our banking sector or of our non-banking sector and of our overall financial sector. In today's environment, as I said, which is characterized by turbulent global spillovers and uncertainties, it's important for the financial sector to follow an adaptive and forward-looking approach to navigate amidst the emerging challenges. This would entail strengthening governance and risk management practices, employing sustainable business models, embracing technological advances and using them to our advantage. On its part, the Reserve Bank will continue to fine-tune the regulatory architecture and the supervisory rigor as may be required to promote long-term resilience and stability of the financial system. Let me now elaborate on each of these aspects. Let me first focus on governance. Strong governance is at the core of resilience, especially in the financial sector. It's applicable to any business entity, but more so in the financial services sector. It is in fact the bedrock for informed and strategic decisions that align with long-term goals and risk management principles. In this context, I would like to highlight three major imperatives. First, effective governance entails establishing clear roles and responsibilities for the board of directors and the executive management of banks and non-banking finance companies. Both of them should possess, that is the boards of directors and the senior executives, that is the senior management of banks, etc., both of them should possess necessary expertise and independence to take the right decisions and to effectively exercise appropriate oversight on operations. Second, robust governance also involves implementing comprehensive internal controls, strong assurance functions, namely risk management, internal audit, and compliance. Internal controls should be designed to detect and mitigate potential risks before they escalate into significant issues. Regular internal and external audits play a critical role in this process as they provide independent assessments of the organization's financial health. They also facilitate genuine compliance with regulatory requirements. Perfunctory compliance with regulations would actually be self-defeating. I am happy to note that at the systemic level, there has been significant progress and improvement in compliance culture in our financial system. The Reserve Bank is bilaterally engaged with the outlier entities wherever it notices deficiencies. The heads of risk management, internal audit, and compliance functions are the conscience keepers of a financial institution. They should have the necessary seniority, independence within the organization to fulfill and discharge their functions effectively. These verticals in a bank or NBFC play a critical role in identifying the gaps and weaknesses, if any, in their organizations and help the management in managing the risks and safeguarding the institution and its reputation. Why I am highlighting these points in a conference of supervisors and also for the regulated entities, the banks and NBFCs themselves, is that these are the areas about which we should be absolutely, we should be clearly focused on them to see that we always remain crisis resistant and we always remain resilient. The third point which I would like to highlight is the importance of ethics in governance, which involves compliance with laws and regulations, both in letter and spirit, pursuit of sustainable business practices, and avoidance of mindless pursuit of bottom lines. I would now focus a little briefly on business models. Both regulated entities and supervisors need to be vigilant to risks, if any, in the business models of organizations. While business models may be designed to drive profitability and growth, they sometimes contain vulnerabilities that may not be apparent. Pursuit of business growth is important, but it should never come at the expense of taking on unacceptable risks. Robust risk mitigants are essential for ensuring long-term success and resilience of a regulated entity as well as the overall financial system. With that, let me now turn to leveraging technology while managing its risks. As the financial sector gets increasingly digitized, adoption of advanced technologies can significantly strengthen the ability of banks and NBFCs to withstand and respond to various risks. It has to be, however, ensured that these technologies are secure, reliable, and aligned with the institution's overall strategic goals. Integrating advanced and emerging technologies such as artificial intelligence, machine learning, and big data analytics into organizational functioning can transform the way financial institutions operate. AI and ML can enhance predictive analysis and enable banks and NBFCs to identify potential risks and trends more accurately. These technologies can improve fraud detection by recognizing unusual patterns and transactions in real time. Thus, they can protect the institutions and their customers from financial crimes and frauds. Operational efficiency can be improved through automation of routine tasks, which reduces human error and frees up resources for more strategic activities. Robotic process automation can handle high volume and repetitive tasks such as data entry and transaction processing more quickly and accurately than humans. As financial institutions increasingly rely on advanced technologies to enhance their operations, the dependency on third-party vendors and service providers may increase. A vendor's inability to deliver services reliably can directly impact the regulated entity's operations as well as customer service. Therefore, a thorough due diligence becomes necessary before selecting such third-party vendors. This includes assessing their financial sustainability, technical capabilities, security standards, and their ability to comply with the regulations. Further, there should be continuous monitoring of third-party vendors to ensure that they adhere to the agreed standards and practices. Now, technology is important, needs to be harnessed, but we should also remember that ultimately it is the human mind which is very important, which has to really read through the technology and which has to really, based on experience and one's own judgment, I think that these aspects are equally important. And technology will throw up many numbers, many trends and many aspects before you, but it's ultimately the human mind, the mind of the supervisors, which has to play its role. And the importance of both technology and the mind of the supervisors, the analytical skills, the technical skills of the supervisors are also equally important. Now, in this context, we have also in the Reserve Bank taken several measures for fine-tuning the regulatory framework and the supervisory rigor. As risks evolve and new challenges emerge, the Reserve Bank as a regulator and supervisor constantly focuses on being vigilant, adaptive and proactive with regard to the regulatory frameworks and supervisory systems to safeguard the stability of the financial system. Over the past few years, the Reserve Bank has undertaken a comprehensive review of regulations under the aegis of the Regulations Review Authority, that is RRA 2.0, which was constituted by the Reserve Bank. Apart from withdrawal of many redundant instructions, the Regulation Review Authority has also made valuable recommendations to ease compliance and reduce regulatory burden, streamline the reporting mechanism and bring in more clarity in regulatory instructions. In fact, in Reserve Bank, we had constituted a group and the group has given its suggestions and recommendations about the number of agenda items which are now placed before the boards of various commercial banks. Many of the agenda items are included in, the agenda at the instance of the central bank. But over a period of time, the list appears to have become too long. So we want to streamline that process and cut out whatever agenda items are not necessary or club together certain aspects which the central bank, as a central bank, we would like the bank to keep the board informed. So that exercise is on. We would like to rationalize the number of agenda items which the management has to place before the board of the Reserve Bank. The management will place all its other agenda items as per its own business and organizational requirements, but there are certain mandatory items which is prescribed by the Reserve Bank. We want to rationalize them and perhaps reduce their size and make them more focused. That exercise is completed, and I think within a month we should be coming out with the required guidelines in this regard. In recent years, the Reserve Bank has also comprehensively restructured the regulatory architecture for banks, both commercial banks as well as urban cooperative banks and NBFCs, housing finance companies. The Reserve Bank has also come out with new regulatory guidelines for asset reconstruction companies, digital lenders, microfinance lenders, and core investment companies. Thus, the financial sector regulations are now not only in sync with the changing times, but also forward-looking with the required readiness to take further proactive measures as may be necessary. Steps have also been taken to set up self-regulatory organizations for fintechs and for NBFCs. This is a completely new approach to facilitate greater consultation and close interface with the stakeholders in the system. It will make regulations even more dynamic and proactive. In the same breath, I would like to emphatically state that there is no intention to make frequent regulatory changes, but only to ensure that there is greater regulatory clarity and responsiveness to the changing circumstances. The Reserve Bank has also significantly strengthened its supervisory systems, transitioning beyond an entity-focused approach to a more thematic and activity-based approach. We now look at sustainability of business models of banks and NBFCs. Root cause analysis of problems and vulnerabilities are also being undertaken. Advance action is initiated wherever we notice or smell a crisis or stress, as was pointed out by Director Ravi Mishra. Structural changes have also been implemented within the Reserve Bank by creating a unified Department of Supervision to ensure holistic assessment of the financial sector as well as to analyze the health of multiple entities within a group. The idea is to enhance agility and comprehensiveness of supervision. Unconventional methods are also being adopted now. On-site supervision of credit information companies has been made annual and more intense. When problems appear too serious in a financial entity, a senior officer of the Reserve Bank in the rank of Executive Director addresses the full board of the organization and shares our concerns. Similarly, when we find material discrepancies between the auditors and our supervisory findings, or when we see that certain material issues are not properly addressed by the auditors, we invite the auditors for a direct discussion. These are some of the examples of our new methods of supervision. The College of Supervisors is itself a shining example of our proactive initiatives to enhance the quality of our supervision and capacity of our supervisors. This is a very critical component of our efforts to strengthen the supervisory system of the Reserve Bank. At the core of the College of Supervisors mandate is the professional development of supervisors both at the initial foundation level as well as during the later stages in their careers. Our effort is to ensure that the supervisors of the Reserve Bank remain abreast of emerging trends, best practices, and supervisory and regulatory developments in the dynamic financial landscape. As the Reserve Bank approaches its centenary year, RBI at 100, we have drawn up strategies that will gear up the Reserve Bank to remain future ready for India's fast-growing economy. We propose to take necessary policy actions for positioning the Reserve Bank of India as a model central bank of the global south. Our goal is to make Reserve Bank supervision a global model by building a through-the-cycle risk assessment framework with continuous horizon scanning and a holistic risk assessment. It also envisages having a more customer-centric framework that protects and promotes customers' interest by improving conduct of supervised entities. In pursuance of this goal, we look forward to active cooperation from all financial sector players and participants, which I am sure they will provide. In conclusion, the journey towards a more resilient, future-ready, and crisis-resistant financial system is ongoing. It demands collective efforts, innovation, and adaptability from all stakeholders in the system. I have delved into certain aspects which are crucial for achieving this goal, ranging from governance and assurance to adoption of sustainable business models, as well as leveraging technology while managing the associated risks of technology. I have also emphasized on the role of regulatory and supervisory framework in safeguarding financial stability. As we move forward, it is imperative for all stakeholders to remain committed to advancing these principles and practices. I am confident that they will continue to contribute to the long-term sustainability and resilience of the Indian financial system. With this, I extend my best wishes for successful deliberations during this 3-day conference and commend once again the organizers for their efforts. May the next 3 days be filled with fruitful exchanges, innovative ideas, and collaborative solutions that would contribute to the process of keeping our financial system resilient, future ready, and crisis resistant. Thank you very much.